Well, you got to be flipping my flapjacks, folks. We are coming upon the end of one of the most insane weeks we have had in the stock market in a long time, where about $10 trillion worth of market cap has reported earnings this week, essentially. And so we got to talk about everything that's going on. This is a very busy video. I just want to get straight into it. We got to talk about Intel's earnings, Apple's earnings, Amazon's earnings, and this right off the go, and then a few other things as well. Hope you guys enjoy this as always, okay? Thanks for joining me. First off here, the economy is officially in recession. I don't care what the government says. I don't care what, this, that. Okay, there's, ever since I was taught economics back in 2008, okay? Here's the deal. If you have 2 straight quarters where GDP is negative, you are in a recession. Okay, and that is exactly what happened. So, these people can say, we're not in a recession, we're not in a recession. There's been one definition for recession for quite some time now, okay? Now, there can be a difference of opinion on if this is going to be a major recession, if it's going to get worse, if it's going to be just this kind of lame recession, but we're not going to see, mass layoffs. That's all debate. Everybody can debate that. But you can't debate that we're in a recession. The fact is we are now in a recession, okay? And so that's just something that I think everybody has to understand. No, the market was all up today, right? And people are looking at the market and they're saying, wait, news comes out, we're officially in recession now, and the market goes up. I mean, you pull up a heat map today, it's green, 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 a lot of green out there today. Well, here's the deal when it comes to this. First off, almost everybody that's educated on the financial markets expected this announcement of officially being in recession here today. This didn't shock anybody. Secondly, and this is very, very important, now this puts the Fed in a situation. We know they just raised 75 basis points, right? This puts them in the situation for the next time they're supposed to raise rates, right? To maybe take it easy a little bit. Hey, the economy's in recession. Things are getting worse. Things are deteriorating. So imagine a scenario now where inflation rate of growth starts to come down. The economy's technically in recession, right? Then all of a sudden the Fed's kind of like, we don't need to be as aggressive because we got some economic worries now. We're technically in a recession. We had 2 straight quarters of negative GDP, and we're in this moment in time in which inflation's maybe getting a little better at that time, right? And so that's something the stock market ultimately likes in the end, and that's why you saw green across the board here today, right? NASDAQ is only down 23% now year to date. Now that's still a massive downward move, and in just about any other year this would be a complete disaster, and we'd be like, what the crap? We're at the end of July and the Nasdaq's down 23+%. Like, what is going on? But for this year, we'll take it. And the reason being is, remember, the Nasdaq was down 34% a month ago, right? And we're in an official summer rally now at this point. It's an official summer rally that's going on. Now, the big question is, how long does it last? Well, based upon some of these companies' earnings here, some of these big dogs, we might be able to get a little more juice out of this one. Let's just put it that way. But it's going to be hard to see a massive move up, and trying to, if you want to think about all-time highs and things like that, it's a tough battle, because everybody's still going to be very concerned, okay? And we're going to go through these numbers here in just a moment. I got some very concerning things to kind of share with you guys, okay? And so everybody's still going to be kind of concerned. We're definitely in a risk-on moment now, moving into for the market. It's clear as day, you can see it in the price action. But that doesn't mean it's all clear and, to all-time highs we go or something like that, okay? It's just, for now, it's at least a clearish situation, let's call it that, right? Meta was down pretty big today, down about 5% or so. Something that was concerning, I listened to the conference call last night, right? And something that was concerning is Zuckerberg kept mentioning the state of the economy, right? And when you talk about Meta, I mean, who doesn't advertise on Meta? It's the biggest companies in the world, the smallest companies in the world, mid-size, everybody advertises on Meta, right? They own Facebook and Instagram, and if you're not advertising on Facebook and Instagram, what are you doing with your company, right? You got to do that. And so we're in this moment in time where Zuckerberg kept mentioning weakness in the economy, and he believes we're going into a downturn. And he said it's hard to predict how bad the downturn would be, but we're going into a downturn. And so, that's one of the most important CEOs, obviously, in the world, right? And if he feels like that, it's kind of like, oh boy, everybody's still going to be wondering, yeah, recession's here. How deep? How bad are we talking? When does the economy get better, right? And the scariest part of that is do we get mass job layoffs, right? Because that is something we saw in the last 2 recessions, right? In the recession of 2020, massive job losses, obviously, and the government helped, funnel money out there basically through stimulus and through everything that happened during that time. We don't need to go through all that, right? But we also, the previous recession, right? 2008, we saw mass job losses. So both the previous recessions, we saw mass job losses. Is this one similar in terms of we see mass job losses? Or is this one of those recessions where it's like, yeah, the economy weakened a bit, slowed down, but we never got those big job losses, right? And so that kind of remains to be seen. But for now, I would just call it the market is cautiously optimistic. That's the best term I would use, okay? Intel reported horrible numbers, absolutely horrible numbers. The stock's down about 9% after hours. This is a stock that's just, this stock's lost money. You lost money in the stock over the past 5 years. I mean, it's just an awful stock. They're getting their lunch eaten. And this is why you have, there's, in the stock market, numbers are important. Financials are important. Income statements are important. Balance sheets are important. But you've got to also look at the business model. And the fact is, Intel has been getting their lunch eaten by their competition. And that's a fact. And ask anybody that knows a lot about this industry, and they will tell you Intel's been getting their lunch eaten for a while. Okay? And so we're in this situation where you look at a stock like Intel and it looks like, oh my gosh, it must be an amazing stock, right? Super low PE, huge dividend yield, very well-established company. Everybody knows Intel, right? They're going to get a bunch of money from this new chips deal that's essentially going through, right, from the government. And you look at those things and it's like, oh yeah. But then you look at the actual fundamentals of the business model and you see they continue to deteriorate. You see they continue to get beaten by competition. And it's like, okay, is this really the stock that's supposed to be so safe? That's supposed to be some moneymaker? This stock's lost money over the past 5 years. This isn't some safe, holy grail stock. Oh my gosh, you're gonna make money in this and it's gonna be safe. Yeah, people are losing money, hand over fist when it comes to Intel. Intel slashed its full year guidance and turned in worse than expected quarterly results. And the company launched new chips that compete with NVIDIA's graphic cards during the quarter. When you got to compete against companies like AMD and NVIDIA, it's tough competition. Never mind Apple potentially making chips. On Tuesday, the U.S. House approved legislation Intel requested would subsidize microprocessor manufacturing in the country, and Intel's supposed to get the bulk of that money. But look at this. Intel falls, as it reports, an unprofitable second quarter. So now this company's gone from this profit machine to unprofitable. Earnings came in at 29 cents a share versus 70 cents was expected. Revenue came in at $15.3 billion. 17.9 billion was expected. I mean, that's over a $2.5 billion shortfall when it comes to revenue. That's one of the worst misses I've seen from any company this entire earnings season. That's just a disaster, right? Intel's revenue declined 22% year over year. The company ended the quarter with a $454 million net loss compared to a $5 billion in earnings in a quarter, the same quarter a year ago. Gross margin went down to 36.5% from 50.4% in the previous quarter. Just horrible numbers. This is why not just numbers are important, the actual business models and what's going on with those companies and what's in the future for those companies is very, very important, guys, because even in a stock like this that's supposed to be so safe, it doesn't look so safe, right? All right, next up here, Apple. So Apple's numbers, what's going on here?
I want to tell you guys for a moment here about one of the coolest stock market services I've come across in some time. It's called Tendies. I've been talking a lot about the volatility in the market recently, right? Institutional money is putting that cash to work. There's going to be opportunities in this market. That's why I like Tendies. They're giving away filtered options flow for free. Yes, you heard me right. For free. So you can see those volatility signals. You can see whale purchases, a ranked chart of bid and ask spreads, and overall flow sentiment. Plus, once you connect your brokerage, you can see your performance layered into everything. Companies like Unusual Whales are charging $40 to $350 per month for the same type of data that Tendies is giving away for free. So check this out. They just launched their web platform this week. They also have an iOS app. I was talking about Meta stock the other day, right? You can see Meta's options flow data in real time. I was talking about Amazon stock the other day. You can see Amazon's options flow data in real time. Brokerage Connect supports your accounts such as Schwab, TD Ameritrade, Robinhood, Webull, and Fidelity. Once you connect your brokerage, due diligence is all in one place. So make sure you take advantage of Tendies and check this out. It will be the first link in the description down there. It will also be the pinned comment. Enjoy that.
EPS came in at $1.20 versus $1.16 was expected. Okay. I gave that one a red because it's still down 8% year over year. It's not good, right? Revenue came in at 83 billion versus 82.8 billion was expected. That's up 2% year over year. I gave them a green for that because, I mean, I think it's amazing that Apple still grew revenue. I really do. I think it's, I think with the current economic environment and with how tough the numbers are Apple's coming off of, right? I think it's very, very difficult to grow this particular business. So I'm impressed that they even grew 2%, honestly. iPhone revenue came in at 3% up year over year. I give them a green for that. I mean, if they can grow iPhone revenue again next year, I think it's a miracle. I think it's just a straight up miracle that this company can even grow anything other than services revenue right now. Now, I gave them a red for services revenue. That was the best part of their business, grew 12%. But here's the thing. Everybody's gotten spoiled with services revenue when it comes to Apple. You know, services revenue has been pretty much consistently growing at 20% plus for a while now. So to then come in with 12%, it's kind of like, okay, are we about to go under double digits now? Or we get, next quarter we're at 9%, 8%, right? And then from there, where do you go? 5%? And then are we talking about potentially negative services revenue at some point in 23? And this is a questions people have, right? Other products revenue, I gave them a red for that. It's down 8% year over year. Mac revenue down 10% year over year. I gave them a red for that. iPad revenue was down 2% year over year. I gave them a red for that. Gross margins, I gave them a green because they did come in better than expected when it came to gross margins there. So, I would call it, for Apple, disappointing quarter, but for most companies, this is a win quarter. I would call it that, okay? But when you look at what Apple's numbers were last quarter and how they just absolutely decimated them, when you look at the previous quarter, how they decimated numbers, we've gotten very spoiled with Apple just destroying their quarterly numbers quarter after quarter after quarter after quarter. They didn't destroy anything here. This was very, okay, Apple, you did the job, but when we get used to you dominating, we're kind of like, okay, this starts to become a little concerning, right? Now, when it comes to stock price, stock is up anywhere from 3 to 4% after hours. We'll see. I think you'll get a good glimpse of what Apple's actually going to do over the next, I'd call it 3 or 4 weeks. There's no stock in the stock market that has more heavy hitters in it than Apple. So if they want to give the illusion after hours like, oh, earnings were really good, everything's really exciting, they can do that, right? But we'll see if, let's just call it some big money starts to exit this stock over the next 3 or 4 weeks. We'll see. Maybe they don't, maybe they do. But I can tell you there's a lot to be concerned about for especially because remember, a lot of the stock market is not long-term investors, right? You have a certain base around Apple that is a long-term investor base. But a lot of people swing that stock, sometimes for a few weeks at a time, sometimes for a few months, sometimes it's like, I want to swing it for the next year. If you're swinging the stock, I don't know if it's, things are lining up there. Let's just put it that way. You got iPhone that's hardly eking out a gain, or is that about to go negative? You have services that is, just keeps going down and down and down as far as growth rates. Are we talking about next quarter's under double digits? What does that mean? You talk about Apple's trading at a very rich valuation now compared to any historical norm for the past pretty much decade, certainly over the past 5 to 7 years. And so you look at all that and it's like, we'll see. Okay, that's all I'll say. We'll see what happens. The truth will come out over the next 3 or 4 weeks in regards to Apple's stock price. Okay. Amazon, there's no question about Amazon. This one's making a massive move up, 12.5% after hours. I got to say, as somebody that's bought stock in Amazon recently, I was shocked, absolutely shocked by one of their numbers I'm going to share with you in this video, okay? So EPS came in at a loss of 20 cents. Part of that was because of the whole Rivian deal. Revenue came in at $121 billion versus $119 billion was expected. So they had a $2 billion beat there from what analysts were expecting. Amazon Web Services came in at $19.7 billion versus $19.56 billion. So a very slight beat for Amazon Web Services, not too exciting there. Advertising, not too exciting either. $8.76 billion versus $8.65 billion was expected. So, okay. Revenue growth is 7%. Topped estimates. Keep in mind for Amazon, 7% is pretty darn lame. Bucking the trend among its tech peers, which have reported disappointing earnings. Amazon said it expects to post third quarter revenue between, this is shocking, $125 billion and $130 billion, representing growth of 13 to 17%. Analysts were expecting $126.4 billion. In Amazon typically is one of those companies that kind of, they sandbag their numbers. I'll just put it that way. They sandbag their numbers usually. So to have them announce that they're actually expecting a midpoint of over $1 billion more than what analysts are expecting. I was in shock because of that. I'll just be completely honest. I was like, what? That's just like crazy. And so this is something that I look at and I say, there's clearly some things going on with the Amazon business model that are more better and more exciting than analysts had expected. And I almost think, I'm like, are they going to seriously come in with like a 130-ish number? And this is something that gives you a lot of conflicting feelings about the state of the economy, right? Because you're like, is Amazon really going to grow like that? And for them to be that confident, it's another conflicting factor that you look at in the economic landscape and in the stock market right now, where it's like, geez, how can they grow like that in this sort of economy? Because that's very, very darn impressive. Maybe, no one can drive to the store anymore, so they need to get Amazon packages delivered to them at their house or something. Because, I was shocked because of that. I'll just be honest. I did not see that sort of guidance coming. Now, Amazon's a stock I bought some shares of recently. I bought 160 shares in my Ally account, and I bought 195 shares in the public account, which is available for everybody in my private stock group to see all the moves I always make in that account, right? And so I got a decent amount of shares, but I should have built this into a six-figure plus position, to be quite honest. I never saw that guidance coming, though. I thought I would have more time to acquire shares of Amazon. So I would love to get Amazon up to a position where I got maybe $100,000 or $200,000 in this position, but I didn't see that guidance coming, man. I'll just be completely honest. I did not see them just blown out of the water because Amazon usually always sandbags. So I figured, okay, maybe they could beat on revenue, but no one's going to get too excited. 12.5% after hours. Yeah, when you come through with that sort of guidance, and Amazon's already a stock that's been hit pretty hard this year, right? It's going to get people really dang jacked up. And so, Amazon's got, flying up tomorrow, and I'm just kind of in this situation that I'm like, why didn't I buy more shares? Because I definitely could have bought a lot more shares, but I went in a little timid. And, given the market we've been in, where pretty much anything you buy just goes down, and you buy this stock and it goes down, and you start almost being trained like, everything's going to go down and it's going to be lower than the price I bought it at, because that's the market we are in for 9 straight months. For 9 straight months, just about every stock you bought, other than maybe oil and gas stocks, went lower, right? And so you start kind of being trained to be like, I got to be a little more timid going into these positions, right? And, it brings me back to this point, because we saw that quarter Tesla report, which was shockingly impressive considering how much was working against Tesla and how the Shanghai factory had to be closed and everything like that. You see the quarter Amazon just put up with a $2 billion beat as far as revenue, over $2 billion beat as far as revenue, plus that guidance that was over $1 billion ahead at the midpoint than what analysts have. And usually Amazon's a company that sandbags. And you begin to start to understand why stocks like Amazon and Tesla trade at huge premiums versus their other, let's just call it big tech competitors. Because you look at the valuation of Apple, you look at the valuation of Meta, certainly. You look at the valuation of Google, you look at the valuation of Microsoft. And Tesla and Amazon always trade at premiums to those companies when you look at forward P's, trailing P's, things like that. But there's a good reason. And the reason is, one, those companies are expected to outgrow all those other companies, right? Which we'll see what happens over the future years, but that's one of the expectations. The other is, those companies just come in and shock you and report quarters that are just like, how did they do this? Like, how did they do this, right? And so that's why those companies traded a huge premium to the market. And the other part of that is Amazon. Remember, Amazon's just gotten to real profitability in the last 5 or 6 years. Before that, their profitability was a joke. And Tesla's just gotten to profitability stage in the last couple of years. So imagine how much, let's just call it ground, these companies are going to cover over the next few years when it comes to increasing their earnings per share and increasing their net income. Imagine where Amazon's net income is going to be in 5 years from now, 6 years from now. Imagine where Tesla's net income is going to be in a few years from now, right? When they're doing 3 million, 5 million vehicles a year, and they've got several factories around the world fully scaled, right? I mean, imagine the EPS that company is going to be able to produce. And the same thing with Amazon versus an Apple that's been a profit beast for a long time now. Google's been a profit beast for a long time now. Same thing with Meta. Same thing with Microsoft. These companies are still in very early days of the EPS game and the net income game, which is ultimately how stocks are valued over the long term, right? And so that's just kind of, something to keep in mind there. So yeah, hope you guys enjoyed this. As always, make sure you take advantage of the pinned comment down there to check out Tendies absolutely for free. Check out all the options flow. It's pretty darn cool stuff, guys. I love what they're kind of putting together there. So yeah, make sure you check that out. It will be pinned comment down there. Much love as always, and have a great day.